Hi and welcome to Random Rogers Big Picture for the week of August 10th, Special Olympic edition. Well, that was quite a week we just had in the stock market, up and down pretty dramatically, a lot more up this week, and all sorts of chatter about what it means and what it doesn't mean. You may have noticed over on Barry's site, he put up some comments that emanated from David Rosen, that's a Fletch reference, who's the economist over at Merrill Lynch, about 300-point days only occurring during bear markets. Then in the comments on Barry's post, it was quickly refuted, but then on Friday afternoon, Jeff Sott said the same thing about 300-point up days only coming during bear markets. And really, I don't think that matters. I don't think that's really the thing. What the bigger macro is, as far as instead of just 300-point days and points versus percentages and all that stuff, valid, but I think it misses the bigger picture, which I'll put up a chart that addresses this from the guys at Bespoke, that during bear markets there is more volatility. That's just how it works, and that is what we're seeing now, is more volatility. There's some statistic out there about how many 1% days we've had and so forth over the last few months. It's a very high number, and I think that is really what is more important. Bear market. Okay, if you think it's a bear market, then you should think that it started last October. And so if that's the case, then we're about 10 months in, I guess. Well, that's a big chunk, time-wise, of a normal bear market. Bear markets, as I understand it, tend to last about 9 to 18 months. We are 10 months in. That's pretty good. And we're all here. Even better. So, in focusing on that, bear market versus bull market, Mebane Faber had a post that was, I think was related, where he jumped on this 300-point bandwagon and its relevance or not, and what he focused on is really the thing that I would say is more important, that most of them tend to come when the market is below its 200-day moving average. And he used a couple of, there's one or two other ones like 200-day moving average that he used in his article, but it's the same big macro, which is more volatility when demand for equities is unhealthy. People tend to be more nervous about the market, more nervous about their portfolios, just more nervous in general about just about everything. So that's where we are now. We're seeing a lot of gyrations because of what's going on. So then the question becomes, well, what should you do? The market's going up, and this could be it. It might be going up a lot. What are you going to do about it? 30 points on the S&P on Friday. That's a big move. However much it was up, I think it was 35 points on Fed Day. That's a big move. You got to be in there. What are you doing about it? Well, here's a not too original thought. How about if you took defensive action, whatever it is that took you out, maybe that could be the same thing that takes you back in. For me, that's the 200-day moving average, which bigger picture is a function of, or is a gauge of health of demand for equities. Above the 200-day, demand can be thought of as healthy. Below the 200-day, demand can be thought of as unhealthy. And for the most part, that approach has worked for me on this cycle. It's worked for other people in past cycles. This is, it's a pretty simple thing to do. I write about that a lot, and hopefully it rings true. Hopefully it makes sense, and importantly, you exercise some discipline. If you had some sort of trigger point that already got you fully invested a while ago, great. This was an even better week for you. But whatever, a little bit of discipline thought of ahead of time, before things turn down and then start to turn back up, let that determine whatever it is you're going to do. And when you think about that, when you're not emotional, that's probably where you want to be. Looking at the current cycle, why is this different than the last feel-good rally that we had from March to May? I don't know why it is, and at this point, it's actually made less of a move. Maybe it will keep going. We'll see. That would be consistent with a bear market for the feel-good rallies to go up, down, up a little less, and so forth until a real bottom comes in, which for a lot of bear markets is a function of time in addition to price, and that is we're not out of it yet. The bottom could be in, though. If we go back above the 200-day, great. Wade in, buy a little bit of stock, buy a little bit more of it, keeps working its way up. But this sort of feel-good rally, and we talked about this before it happened, just because it was guaranteed to happen. This is how bear markets work. They have feel-good rallies. The rally on and the September 11th, off the September 11th low, that was a huge rally. That was enormous in the context of a bear market. There were other periods like that, and in the future there will be other bear market rallies. One other thing I wanted to talk about, I tend to use the term bull and bear market. Long-time readers, really long-time readers will know I'm not a huge fan of those terms, but for economy of words, they make sense. The thing that matters and what drives me, and even in client conversations, bull market, bear market, it just saves a lot of words. But the thing that is important here, and I'm going to go back to what I just said a minute ago, is the health of demand for equities. I would expect demand for equities to start to be unhealthy long before after the top, but long before things get ugly and scary. That is how it worked on this go-around. That's how it worked on the last go-around. Conversely, demand for equities probably would get healthy after it bottoms and starts to work its way up, yet we might still be technically in a bear market, however it is it's being defined these days. I would say, and really in the context of managing your own money, don't worry about the terms bull market and bear market. Have some sort of trigger point where demand is healthy versus where demand is unhealthy. When demand is healthy, you probably want to be invested. When demand is unhealthy, you probably want to have a reduced exposure of some sort. Hopefully that makes sense. Enjoy the Olympics. Enjoy all the feel-good moments up close and personal, and all that fantastic gymnastics that they're going to club us over the head with. Hopefully you've got all the other channels. To the extent you care about the Olympics and watching sports that are not gymnastics, you've got all those other channels, and you can see some things you probably care about or are a little more interesting anyway to watch. Have a great weekend.